All right, let's just get right into it. Welcome to the deep dive. I'll be your host today, looking at this from a macro strategist perspective, following the capital flows.
And I'm here as your resident tech and semiconductor analyst, ready to dig into the actual operational data.
Yeah, and today we are looking at a company that presents a pretty genuine paradox in the market. We are talking about HD Hyundai, ticker 267250.
Right.
Now, if you just hear the name, you probably think of a massive industrial conglomerate. You picture heavy steel, sparks flying, maybe some grease.
The classic Rust Belt giant.
Exactly. But if you look at the valuation right now, something really doesn't add up.
It really doesn't. We're looking at a market cap hovering right around 18 trillion Korean won. But if you actually sit down and do the math.
Which you love to do.
I do. And if you add up the market value of their listed subsidiaries, the book value of the unlisted ones, and the raw cash flow, the market is valuing the parent company at significantly less than the sum of its parts.
Right, the classic holding company discount. It's a super common theme in Asian markets, but this specific case feels extreme. It begs the question, right? Like, is this just a value trap? Is the market right to discount it because it's just this clumsy collection of old economy industries? Or are we missing a fundamental structural shift here?
And that is exactly the mystery we're unpacking today, because the sources we're looking at suggest the market is essentially driving while looking in the rearview mirror. They see a dirty oil refining holding company. But the data on the ground describes a transition into what they are now calling an energy and data platform.
Energy and data. I mean, that sounds a lot like Silicon Valley marketing fluff.
It does.
But our mission here isn't to buy into the marketing, right? It's to find the structural inflection points. And just to be absolutely clear with you listening, before we go any further, we are not giving financial advice today.
Right. No buy, sell, or hold recommendations. We aren't timing the market.
Exactly. We are strictly looking at the fundamental changes in the business model. We want to understand if this machine has actually evolved or if they just, slapped a new coat of paint on it.
Well, to answer that, we really have to look at their failure phase. You can't appreciate the current setup without understanding the absolute mess they were in between roughly 2017 and 2020.
Take us back there, because in 2017, the market definitely didn't call them an energy platform. They called them something much less flattering.
They were labeled an oil-selling holding company. And to be fair, that was completely accurate. Even though the name said Hyundai Heavy Industries, the actual profit wasn't coming from building ships. It was coming from oil refining through their subsidiary, HD Hyundai Oil Bank.
Which is just a terrifying position for a holding company. You are essentially just a proxy for global oil prices. You have zero control over your own destiny.
Exactly. It was a one-legged stool. If refining margins were up, the stock went up. If margins crashed, the whole company crashed. And in 2020, that leg got violently kicked out from under them.
The pandemic.
The pandemic. It was a literal hell scenario for them. Global oil demand just evaporated overnight. And the refining sector posted an operating loss of 593.3 billion KRW.
Wow. Nearly 600 billion won in operating losses. That's the kind of number that gets executives fired and entire corporate strategies ripped up.
It was a massive wake-up call. They realized that relying on oil for 70 to 80% of their profit wasn't just risky, it was a fundamentally broken model. They realized a one-legged stool falls over, but a tricycle is stable. They desperately needed diversification.
Okay, so the pivot begins. The sources mention this tricycle structure. I assume oil is still one of the wheels. What are the other two?
Yeah, so the second wheel was bolted on in 2021 through a massive acquisition. They bought Doosan Infracore. This brought construction machinery fully into the fold. So now you have oil and you have construction.
Okay, still classic heavy industry, though. But the third wheel is where this story actually gets interesting. Shipbuilding, which had always been there, but it was bleeding money for years.
Right. But then the geopolitical landscape completely shifted.
Yeah.
The post-Ukraine war era exploded the demand for energy security worldwide. Suddenly, the whole world needed to move gas across oceans instead of through pipelines. They needed LNG carriers, liquefied natural gas ships. And guess who held 30 to 40% of the global slots for building those specific ultra-high-tech ships?
HD Hyundai?
Yep.
So they didn't just have shipyards. They had the exact right shipyards for the specific macro crisis the world was facing.
Precisely. And that brings us to the present day. If you want to see if this pivot is real, you don't look at net income, you look at the operating cash flow, the OCF. This is the raw cash generated from actual business operations on the ground, not financing or accounting tricks.
I was actually looking at this in the notes before we started. In 2020, their OCF was 0.5 trillion KRW, basically just keeping the lights on.
Right. And by 2024, that number surged to 7.5 trillion KRW.
That is a 9x increase.
It's a completely different animal now. They even changed the corporate name from Hyundai Heavy Industries Group to just HD Hyundai. They dropped the heavy industries part because they argue they are now a technology platform.
Okay, I'm going to stop you right there. A 9x cash flow increase is incredibly impressive. But as a macro skeptic, I have to ask, is this just a super cycle? Did they just get lucky that oil and ships became expensive at the exact same time? Or is there physically something different about how this corporate machine works?
That is the critical question. Is it luck or is it structure? And the field data points heavily to structure. I call it the triangle formation. They have three specific engines firing simultaneously, and more importantly, they're completely uncorrelated.
Okay, let's break these three engines down. Engine number one is shipbuilding, HD Korea shipbuilding, and offshore engineering. We know about the LNG boom, but shipbuilding is a notoriously cyclical industry. Why is this time any different?
It's all about the order book lag. In shipbuilding, you sell a ship today, but you physically build it for the next 2 years. For a long time, their yards were clogged up building ships they sold at rock-bottom prices during the lean years. They were essentially working overtime just to lose money.
Ah, the classic profitless prosperity.
Exactly. But now, that toxic backlog is finally cleared out. They are currently delivering the high-priced ships that were ordered in 2022 and 2023. We are seeing the operating profit margin, the OPM, steadily climb. It was 3.3% in 2023. It hit 4.4% in 2024, and guidance suggests 4 to 6% in 2025.
And there's a massive macro tailwind here too, right? The exchange rate.
Oh, it's a huge factor. Ships are sold globally in US dollars. But the internal costs, the labor, the steel, the electricity, and Ulsan are all paid in Korean won. With the exchange rate hovering around 1,400 won to the dollar, their translated profits get a massive structural boost just from the currency conversion alone.
Right, okay. So shipbuilding is super healthy. That's engine one. Let's talk about engine two, because this is the one that seems to be catching the eye of the deep tech investors, which is wildly unusual for a heavy industry company. Power and grid.
Specifically, HD Hyundai Electric. This is their direct physical connection to the AI boom.
Explain that connection for us. How exactly do we get from a ChatGPT prompt to a Hyundai transformer factory?
It's the physical reality of artificial intelligence. We always talk about the cloud, right? But the cloud is actually rows of physical servers sitting in massive concrete buildings. And those servers are incredibly hungry. They literally eat electricity.
And the current U.S. grid can't feed them.
Not even close. The U.S. power grid is practically geriatric. In many key places, the infrastructure is 50-plus years old. It physically cannot handle the massive megawatt load required by these new hyperscale data centers. So there's a screaming, desperate demand for high-voltage transformers and power distribution equipment.
And HD Hyundai builds the hardware.
They make the ultra-high-voltage transformers that are currently the main bottleneck of the entire AI industry. The shortage is so acute right now that sources in the field describe it as a pure seller's market. Essentially, HD Hyundai names the price, and the tech giants just say thank you.
That is an incredibly rare position in industrial manufacturing. Usually you are fighting tooth and nail for pennies on the margin.
Not here. The operating profit margin for this specific division is over 20%, and their order backlog is completely full until 2028.
Wait, 2028? So if I'm Google or Microsoft and I need a transformer for a new data center today, I can't get one from them for 4 years.
Essentially, yes. You take a ticket and you get in line. This single division, which used to be just a minor background player, now accounts for 20 to 30% of the entire group's profits.
That's wild. A heavy metal transformer company operating with software-like margins. Okay, so that's power. What is engine 3?
Engine 3 is MRO, maintenance, repair, and operations. This is HD Hyundai Marine Solution.
Okay, I'll be honest. This sounds significantly less sexy than AI power grids. This sounds like a giant mechanic shop.
It sounds boring, I know, but financially, it is the most beautiful model of the three. Think of it as the classic razor and blade model. Engine 1 sells the ship, that's the razor. Engine 3 services that ship for its entire 30-year lifespan. Those are the blades.
Ah, I see. So it's locked in recurring revenue.
Exactly. And they have a secret weapon here called the HIMSN engine.
HIMSN. Is that some sort of acronym?
Yeah, it stands for High Touch Marine and Stationary Engine. It's their own proprietary technology. I've actually walked the factory floor in Ulsan, and the scale is staggering. Historically, Korean shipbuilders were just assemblers. They paid massive royalties to German or Finnish companies like MAN or Wärtsilä for the actual engine designs.
Right. They did the heavy lifting, but gave away the high margin IP.
But HD Hyundai spent years developing their own. Now, they are the ones exporting the technology and collecting the royalties. They are the global #1 in medium-speed engines with about a 35% market share.
So roughly 1 in 3 ships globally runs on their engine.
Correct. And they recently acquired STX Heavy Industries, which completely fills out their lineup for the smaller engines too. So look at the structure now. If you want to build a ship, you basically must go through the HD Hyundai ecosystem. You buy their ship, you buy their proprietary engine, and you sign a 30-year contract for them to fix it.
That is a wildly powerful moat. Okay, so to recap, we have 3 engines. Shipbuilding is making money on high-value orders and currency. Power is making 20% margins on the AI hardware shortage. And MRO is locking in 30 years of long-term cash.
It is an incredibly solid fundamental lineup.
However, and here's where I usually get stuck, and I think where a lot of institutional investors get stuck too. How does this actually help the person holding the parent company stock? We see this all the time in Asian conglomerates. The subsidiaries get rich, they retain all the earnings, and the holding company just sits there doing nothing.
And this is the real aha moment of this deep dive. You have to look at their specific cash extraction mechanism.
Cash extraction mechanism. Sounds slightly menacing. How exactly do they get the money up to the top?
There are 3 main pipelines. First, obviously, are standard dividends from the subsidiaries. But the second one is the absolute cheat code brand fees.
Brand fees, like the subsidiaries paying just to use the name Hyundai.
Exactly. But here is the crucial fundamental nuance. The fee isn't linked to subsidiary profit. It is directly linked to subsidiary revenue.
Oh, wow. Okay, so even if the shipyard has a bad operational year and their margins get squeezed tight, as long as they are physically selling ships, the holding company still gets paid.
Precisely. Think about it. As HD Korea Shipbuilding hits 40 trillion KRW in revenue, the cash flowing up to the holding company as a brand fee automatically explodes, completely, regardless of the raw material costs or labor strikes below. It is essentially a top-line tax that flows directly to the parent company.
That is an incredibly favorable structure for the holding company.
It really is. And then you add the third pipeline, which is steady rental income from their massive real estate properties. But here is the ultimate payoff for you listening. HD Hyundai has instituted a policy of a 70% dividend payout ratio.
70%, that's high even for a real estate investment trust, let alone an industrial holding company.
It's incredibly aggressive. It effectively turns the holding company into a giant dividend ATM. The money flows up from the ships, the AI transformers in the service contracts, hits the parent holding company, and 70% of that is pushed directly out to the shareholders.
Okay, that definitely answers the why you should care question. But let's pivot back to that tech label for a minute. They call themselves an energy and data platform. We talked a lot about energy. Where is the data? Is this just marketing to try and secure a higher tech valuation?
It's not just marketing, but I will admit it is early stage. We need to talk about Avicus.
Avicus. It sounds like a sci-fi villain.
It's actually their autonomous navigation subsidiary. Think of it as Tesla Autopilot, but for massive commercial ships. In 2022, they actually achieved the world's first trans-Pacific autonomous crossing by a large commercial vessel.
Wait, a massive commercial ship crossed the entire Pacific Ocean driving itself?
It did. And why this matters fundamentally isn't just because it's a cool piece of tech. It completely shifts the valuation model. Right now, a shipbuilder gets a manufacturing multiple. It's a low valuation because they physically build and sell a product one time. But if you sell the software subscription that navigates the ship forever...
That's recurring revenue.
Exactly. That gets a platform multiple, which is much, much higher in the capital markets.
So their long-term vision is essentially sell the ship, fix the ship, and drive the ship via software.
Exactly. But there's a flip side to this high-tech push. We have to address the elephant in the financial reports: robotics.
Yeah, I noticed this in the Q3 filings. HD Hyundai Robotics, it's currently losing money, right? An operating loss of about 7.9 billion KRW recently. Is this a giant red flag? Like, is it a cost black hole where they are just burning cash on cool tech toys?
It absolutely looks like a black hole on the balance sheet right now, but you really have to view it strategically. The single biggest fundamental threat to shipbuilding right now globally is labor. There just aren't enough welders. Young people in Korea, and frankly everywhere else, do not want to weld metal inside a sweltering ship hull in the middle of summer.
So the robots aren't primarily a product to sell to others. They are a vital necessity just to keep their own factories running.
Exactly. It's heavily in an investment phase. They are actively developing robots for the most hazardous tasks inside their own yards. If they can turn this around, it becomes a major hidden card for valuation. But for now, it is a conscious cost center they are accepting to save the much larger business from a demographic labor crisis.
Okay, we have painted a very rosy picture here so far. 3 roaring cash engines, an automated extraction machine, future tech upside. But my job as a strategist is to be the buzzkill. I want to do a hostile interrogation of this thesis right now. Let's pop the balloon.
Bring it on. Let's do it.
Risk number 1, the peak out theory. You said the power division has 20% margins. That is wildly abnormal for hardware manufacturing. When global supply finally catches up, and it always does, won't those profit margins crash?
It's a totally fair point. 20% is very likely the absolute peak of the cycle, but here is the data: defense volume versus margin. Even if those margins normalize down to a healthy 10 or 15%, the sheer volume of orders is structurally increasing. The AI giants, Google, Microsoft, Amazon, they aren't stopping their data center build-outs next year. That baseline structural demand creates a floor. The profits won't fall off a cliff. They will likely just settle at a very, very profitable baseline.
Okay, fair enough. Risk number 2, oil volatility. You said they diversified, but oil bank is still 40 to 45% of top-line revenue. If macro oil prices crash again, aren't we right back to the one-legged stool hell of 2020?
We would be, if not for the Aramco shield.
The Aramco shield.
Saudi Aramco. They're a major shareholder and a strategic partner. They recently signed a 20-year crude oil supply agreement, valid all the way until 2039.
What does that actually give them functionally? Just a guaranteed supply of crude?
No, it gives them guaranteed supply at a structurally competitive cost basis. This essentially guarantees them baseline refining margins that simply did not exist during the previous market crises. It puts a massive safety net under the entire oil division. It functionally prevents the 2020 hell scenario from ever repeating.
That is a pretty sturdy safety net. All right, risk number 3, and this is the big one, the holding company discount again. Why should I, or anyone listening, buy the holding company when I can just go into the market and buy HD Hyundai Electric directly? That stock is listed. If I like the AI grid theme, I'll just buy the pure play. Why deal with the messy conglomerate at all?
The double listing problem. It's a genuine disease of the Korean market.
Yeah.
But the defense here is twofold. One, the dividend yield we discussed. That 70% cash payout is entirely unique to the holding company. But 2, and this is crucial, it's the unlisted assets.
The parts of the company you literally cannot buy separately.
Exactly. If you buy the electric company stock, you only get the electric company. If you buy HD Hyundai, you get exposure to the electric company, plus the entirely unlisted oil bank cash cow, plus the unlisted robotics division, plus the unlisted Avicus software. You are buying a massive basket of vital assets at a structural discount that is actively narrowing because of that aggressive dividend policy.
So you're essentially getting the hidden parts, the oil cash cow and the AI robotics future, practically for free.
In a way, yes. The market is currently pricing the holding stock as if those massive unlisted parts aren't worth much at all, which the operational data suggests is just fundamentally wrong.
So bringing this all together, we've gone from a Rust Belt oil refiner to AI data centers. If you had to summarize this entire structural transformation for someone watching this space, what is the core elevator pitch?
It is a fundamental shift from oil and steel to data and capital. They've moved from a fragile business model that just sits around praying for high oil prices to a machine that systematically extracts value from three massive global megatrends: energy security, artificial intelligence, and global logistics.
And for you listeners who want to keep track of this on your own, what are the specific signposts? What should they be watching for in the next few quarterly earnings reports?
I have a specific watch list of three structural inflection points for you. First, watch the shipbuilding OPM. If it hits 10%, that is the ultimate confirmation that the toxic low-price orders are fully flushed out of the system. That's a massive green light signal.
Okay, shipbuilding OPM hitting 10%. Got it. What's number two?
The brand fee rate hike. There is a public corporate disclosure expected later this year. If they raise the percentage rate on that revenue-linked fee we talked about, it structurally and instantly increases the raw cash flow straight to the holding company.
That's the cheat code getting a software upgrade. And number three?
The robotics turnaround. Watch closely for the exact quarter that division goes from red ink to black ink. That is the exact moment the cost center becomes a profit center, and the broader market will be forced to completely re-rate the value of that hidden asset.
It's truly fascinating. It's not about jumping in and trading the stock today. It's about watching the speed and the fundamental structure of this corporate change. It's literally like watching a giant rusty oil tanker physically transform into a high-speed boat.
A high-speed boat driven by autonomous AI software, no less.
Exactly. And that brings us to a final thought for you to chew on. We talked about the aggressive dividend yields, the massive earnings growth from the AI grid, and the potential valuation re-rating. In macro strategy, it is incredibly rare to see all three of those forces colliding at the exact same time. Usually, you get high growth or you get high yield. You rarely get both. Here, the thesis suggests you might actually capture both as the market wakes up to the new reality.
That's the triple threat. And honestly, that is why this particular deep dive is so interesting. It fundamentally challenges all of our lazy assumptions about what an old economy company can actually become if they are forced to adapt.
Well, that is plenty to mull over. From the welding yards of Ulsan to the hyperscale AI data centers, HD Hyundai is certainly charting a completely new course. Thanks for taking us through the ground level numbers today.
My pleasure. Anytime.
And thank you for listening to this deep dive. Keep your eyes on those structural inflection points, and we'll see you on the next one.